Markets enter the final stretch of the year in a cautious mood, with European equities struggling to find direction and global investors increasingly fixated on upcoming US data. Trade tensions, on the other hand, with China continue to simmer in the background, adding to Europe's already fragile growth outlook for next year. While on the other hand, rotation into cyclical sectors remain convincing, but also at risk of fresh trade frictions. So attention now turns squarely to the United States, where the final batch of macroeconomic data could shape expectations well into the new year, with Fed funds futures finally balanced and positioning increasingly one-sided. Even modest upside surprises in growth and inflation data from the US could force a rethink. So welcome to Swissquote's Daily Market Talk. It's December 23rd. I'm İpek Özkardeşkaya. And everything I will say in this video are based on my own personal opinions, and this is not financial advice. So the week started on a mixed note. Appetite in Europe was rather limited, with major indices trading flat to negative on Monday as China announced tariffs of up to 43% on EU's dairy imports. Even the energy and mining heavy FTSE 100 index couldn't eke out gains yesterday, and that despite a rally in the broader energy and metals complex. Now, the heating tensions with China are nothing new for Europeans, but the fact that the Chinese are now dumping their products in places outside the United States, including Europe, is sure creating a lot of tensions across the old continent that's dealing with its own cost of living crisis since pandemic. You'd say that the cheap Chinese products are good for taming the inflationary pressures in Europe, and they sure are, but the problem with that is they make the European-made products relatively more expensive than they already are, and hence they weigh on local businesses and local jobs. And I'm not only talking about the local cheesemakers and the French bistros. I'm also talking about this continent's growth engines, like the big French, Italian, and German car makers, for example, that totally missed the electric vehicle turn and are being crushed by the Chinese competition these days, with the Chinese EVs flooding the European markets right now under the eyes of traditional European car makers, shocked to see people opt for better software, better technology than luxurious interiors. Also, if you haven't noticed, we as Europeans are missing in real time the AI turn. We have no big technology platforms, we have no major innovations, we have a lot of incredibly strict rules instead, and the money is slowly running out. And now the European tariffs on Chinese stuff are backfiring, with Chinese slapping tariffs as well on the European products, and this is not great news for what's to come. It could actually weigh on European growth next year, and the European growth is already not very brilliant. So broadly, the Trump playbook is contaminating international trade relations. The thing is, the US has massive AI and technology investments to mask their anemic growth in other sectors. Europe doesn't. The European watches, bags, luxury cars need actually to join their US and Chinese consumers. And if these pillars fall for the European economy, it will be hard for the Europeans to find another way to turn things around. The technology is not an option, and ASML alone can't lift an entire continent's economy. The defense sector was good, actually shouldered this year's stock rally in Europe, but may also have explored much of its upside potential this year, and there may not be as strong rally next year. The heightened defense budgets will sure flow into military stuff makers, but Europeans will eventually hit budget restrictions here as well, won't they? Spending there could hardly match the big technology spending on data centers and chips. So what's next? Well, the consensus in the actual market environment is still pointing at further rotation into cyclical names that the Europeans should continue to benefit from, along with relatively lower European borrowing costs, with trimmed exposure to technology holdings that are posing problem to global risk appetite these days due to their high valuations. But any further trade tensions with China this time could kill whatever is left of hope for European economies to grow next year. And I'm not exaggerating. One of the most miserable European economies, the United Kingdom, has just printed a 0.1% growth in the third quarter, if you can call it growth. Because yes, the UK economy grew 0.1% for 3 months, to justify my choice of the word miserable to describe that growth performance. It basically didn't grow at all. But by looking at cable's performance these days, you could barely believe that the Bank of England has just announced an interest rate cut last week, and the UK announced a few very weak economic data that will further weaken due to a growth killer budget that the government has announced in November. But alas, it's not sterling's gains, but it's rather dollar's losses that are defining the direction in cable today. And as per the US dollar, the dollar has been heavily sold on many reasons this year, if you haven't noticed. First, the US dollar has been under pressure since Donald Trump took office. The obvious lack of budget discipline, trade tensions, the waning appetite for US treasuries, and the US dollar for reserve purposes, and now the dovish Federal Reserve expectations. All explain why the US dollar has been so heavily hit this year. And in a very short one, say since yesterday, the dollar is also under the pressure of a decent retreat in the dollar yen on Japanese authorities' threats that this long dollar yen trade has gone too fast and probably too far, and that they will be doing something about it. But beyond the short-term noise, the US dollar outlook remains comfortably negative into next year. I mean, I haven't heard anyone give a bullish call for the greenback, except for some big bank analysts now calling the end of the US dollar's depreciation sometime in the second half of next year. But that also makes me think, if everyone thinks the same way, then the US dollar's weakness may have already been mostly priced in. Therefore, there is a chance that any piece of news or data that would back a hawkish readjustment in Fed expectations will lead to a sharp US dollar rebound. So all eyes are on this year's last economic data from the US, with the US third quarter GDP update and the PCE data, which is the Fed's favorite gauge of inflation, on the menu du jour ahead of our Christmas break. The US economy is expected to have grown more than 3% in the third quarter, 3.3% according to a consensus of analyst estimates on Bloomberg, with AI investments making up a big chunk of this growth, of course, while the price pressures are expected to have rebounded as well. So a combination of stronger than expected growth and higher than expected price pressures could eventually revive the Federal Reserve hawks if, of course, the more updated PCE data doesn't look soft enough to help the Dows fight back. Right now, activity on Fed funds futures gives around 20% chance for another Federal Reserve rate cut in January next year, and a little more than 50% chance for a March rate cut. Any rise in the probability of further Federal Reserve easing should give a boost to stock valuations. But the non-technology and more cyclical pockets of the market are expected to benefit more from the Fed's dovishness than the highly valued big technology names. And as per the Santa rally that happens the 5 final trading days of a year and the 2 first trading sessions of the new year, that since 1928 printed a 1.6% rally on average, well, the bets are still in favor of further gains. But that doesn't exclude the probability of a meltdown that we might see later in January. So let's see what the final data of the year will say and how investors will react. This year has sure been full of twists and turns, uncertainties. The technology still led gains, but we have seen a notable rotation still toward the non-technology and non-US pockets of the market. So if anything could throw a floor under a potential technology sell-off in the coming weeks and in the coming months, it's that hope that the technology-led rally will broaden elsewhere than technology and elsewhere than the United States. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.